So what is the difference between velocity banking and infinite banking? That is a fantastic question, and the bottom line is those are really two completely separate things. So let's break it down and let's discuss it in today's training. Hey everyone, it's Mike Adams, and on this channel we empower individuals to achieve freedom through improved financial literacy and business ownership. If you are new to this channel, make sure to click subscribe and click that bell so that way you get notified on any and all of our future content. So in today's video, guys, we are going to be breaking down and discussing what is the difference between velocity banking and infinite banking, okay? And if you've been a subscriber to this channel, velocity banking is really one of the cornerstone concepts that we've really talked about here. And infinite banking is something separate, but it is something that we're going to put a lot of emphasis on over the next couple of months to create some really good solid content around this particular topic. Infinite banking is actually really, really cool, and it's a strategy that before my wife and I really had a name for it, it was something that we were utilizing. We've utilized that strategy multiple times, in our life, and didn't even really realize it was a strategy until, or didn't really realize that there was a name for that strategy until just a couple of years ago. So you're going to learn more about that here for sure. Be on the lookout for future videos regarding the topic. But in this video here, we want to really just break down the definition and talk about the difference between the two. So to start, obviously, with velocity banking, this is primarily used as a way to save money and interest by paying down our amortized loans faster, leveraging a line of credit. And so it's a great strategy. I mean, you can use it for multiple different things, but here on the channel, we primarily talk about it in ways to pay off your mortgage, pay off your student loan, or even your auto loan or any other type of loan that you're dealing with, leveraging a line of credit. So in an example of, let's say we're paying down a mortgage here, and let's say you had a $300,000 mortgage and you have a $30,000, let's bump it up. Let's say you got a $50,000 home equity line of credit. And so instead of making your regular monthly mortgage payments on that, over the course of 30 years, you're gonna pay a lot of money in interest on that loan. If you are, and I'll just give you a quick example, if you had a $300,000 mortgage, and I know rates are much lower than this right now, but just to make it easy and kind of give you guys just a mental picture, a mortgage at 5%, okay? Then when you think about your mortgage rate, the actual rate, there's actually a sneaky little formula that kind of gives you the actual amount of interest you're gonna pay over the life of the loan. And so I like to use 5% because it makes it simple to plug into the formula. So you take your interest rate, and let's say 5%, you multiply that times 2, okay? So 5 times 2 would be 10, and then you add a 0. So a 10 and you add a 0, that means 100. So on a 5% mortgage, 5% amortized mortgage, you're gonna pay 100% interest. Okay, so that $300,000 property over the course of 30 years at 5%, you would pay $600,000 for that house. So you're literally paying for the house twice, okay, in pure interest. And so when you realize that, so even if you're at, 3%, if you got a 3%, mortgage, take that 3 times 2 gives you 6, add a 0, and you got 60%. So on a $300,000 loan, you would actually pay a total of $480,000 on that mortgage, okay? Because $180,000 would be 60% of $300,000. So that's kind of some people call it dirty math or cowboy math, but that's one easy way to really understand how much money you're actually going to pay on this loan over the life of it. And that's where strategies like velocity banking come in great, because instead of paying on this loan for over 30 years, if you're able to pay off your mortgage in anywhere from 5 to 8 years, you're able to significantly reduce the amount of interest you're paying over the life of the loan. And that is really what most folks that are wanting to learn velocity banking, that's what it's all about for them, is how do I pay off this student loan, this auto loan, this mortgage, And again, we're leveraging a line of credit to do so. Now, infinite banking is honestly a completely separate and different concept to velocity banking. Now, is it a concept that you can use in conjunction with velocity banking? Absolutely yes, okay? So infinite banking is different because what infinite banking is all about, and there's plenty of videos already on YouTube, plenty of training online that you can gain access to learn about. Sometimes it's called infinite banking, sometimes it's called cash flow banking, and really what this is all about, and this is where you're bringing in permanent life insurance policies that grow cash value. Okay, and we are definitely going to get into the details and break down some of this insurance stuff in future videos. But if you have a permanent life insurance policy, and again, that's different from term insurance. Now, term insurance, okay, you pay X amount of dollars every single month, you get a death benefit if you die during that particular term. But there is no cash value. With a permanent life insurance policy or a whole life insurance policy, part of your payment is going to go to fund your death benefit, but another portion of your payment is going to serve as kind of like a savings component. And it's this savings component that grows a cash value. And once your policy, and it takes a couple of years to build this up, of making these policy payments, typically, 2, 3, 4 years into the policies where you're really going to see that cash value number start to kick in. But once you have cash value there, you can then leverage that cash value. So let's say you have a policy, like my wife and I, we have policies with New York Life. And so we have plenty of cash value in our policies. And let's say that we needed funds for a project or we wanted to buy something. Rather than me going to the bank and having to qualify for a loan, fill out the paperwork, put up collateral depending on what the loan is and what that's all about, I can avoid that if I have enough cash value inside of my policy. What I can do is I can literally, with New York Life, I can literally go online and keep in mind this is not an endorsement of New York Life. That is just where we have some of our policies that we've used over the years. There's a few really good companies where you can get the right kind of policies for this strategy that can grow a good sizable cash value quickly. So again, this is not just a clean endorsement of New York Life. That's just where we have some of our current policies. But let's say I needed $50,000 for this particular project. As long as I have that much cash value, as long as my policy has that much cash value in it, I can literally jump online or pick up the phone and call my agent, and they will literally give me a loan secured by the cash value in my policy. So instead of me paying interest to a bank, right, or having to go through that whole qualification process, I can literally just take a loan against my policy. Some of you guys may be familiar, like at your job, where you can take like a 401k loan. If you got an active 401k with your company, if you really needed some money and you didn't have, let's say, the credit in that moment to go and qualify at the bank for a loan, you could take a loan against your 401k. And then your 401k kind of stays in there, continues to grow at whatever rate it's growing at. And then you start making payments to pay that back with a little bit of interest that goes back into your 401k. With the life insurance, so let's say I needed 50 grand out of there. So with the great thing about this is that with the cash value is going to stay in the policy. So you're not removing the cash value out. You're leaving it in there. And with ours, it's growing at 4%. Now it's 4%. The be all end all when it comes to investments. I want to get that 4%. But I'll tell you what, it certainly beats any savings account that's really out there right now. And it's guaranteed growth, okay, which is great. So that money stays in there growing for me at 4%. And then my insurance company will charge me 5% for the loan. So essentially I'm paying 1% interest for the use of that money. Now, a couple of things that are really convenient about this. Number one is that there is no minimum monthly payment. Okay, so if you go to the bank and get a loan for 50 grand, you will have a fixed monthly payment every single month that you need to make until the loan is paid off in full. When you take a loan against your own cash value, there is no fixed monthly payment. As a matter of fact, if you did not pay that loan back ever, as long as you continued making all your premium payments and kept the policy active, they would just take the balance of that loan out of your death benefit when you pass away. So it's powerful. You don't necessarily, you can pay these types of loans back on your time schedule. Now, does that mean take out the loan and not pay the cash value back? Absolutely not. With infinite banking, you do want to pay that back because you want to be able to use it again in the future. And so if you're working on a project, let's say you're doing a fix and flip with that 50,000 bucks, once you make your money and the flip is done, you can go ahead and pay that back to, again, bring your cash value up to 100% again as far as on your policy there. And then you can redraw from that policy again as you see fit, depending on what purchases you want to make. And that's where the term kind of bank on yourself kind of comes into it. If you have enough cash value in your policy, you can leverage that over and over and over again, as long as you pay it back, to make the purchases that would normally require a bank. One of the ideas that my wife and I came up with once we really started to understand this is like, wow, in the future when our kids, let's say they get to a point where they're ready to go out there and buy a house, and we're a ways away from that, they're only 7, so we're a ways away there. But let's say they're looking to buy a property, and let's say that property is going to be $250,000. Well, instead of them having to go to the bank and get a loan and pay the bank a ton of money in interest, again, of course, we'll teach them about velocity banking, things like that they can use. But let's say they're not in a good credit scenario. Let's say they run a business or they're self-employed where their taxable income isn't as high, so they're unable to qualify for the amount of money that they're looking for. This would be a way for, again, they could use our family bank. That way, we could take the loan against our cash value, purchase the house in full in cash, and then set it up an agreement with the kids to pay back our cash value loan. And we could set up a nice, reasonable payment, allowing them to go ahead and pay that back, knowing that we're just paying 1% interest on the money. So it's a fantastic way, and we've used this a bunch of different times to make purchases. We've leveraged the cash value in our policies to pay off other loans, allowing us to eliminate that payment. Like imagine if you had a vehicle loan, 20,000 bucks, and you got a $600 monthly payment there. If you had that cash value in your policy, you could take a loan against that cash value, pay off the loan immediately, and then from there, you would just have this loan against your cash value that you'd be able to pay back on your own schedule. You'd be able to take that payment that's normally going to a loan company and recoup that into your cash flow. And from there, again, pay back your policy loan on your schedule, on your time frame. Knowing that even if you didn't pay it back, as long as the policy stays in force and paid in full on the premiums, they would just take that loan balance out of your death benefit when you pass away. So it's a powerful tool, and I've had even people use this tool with velocity banking. So typically with velocity banking, this is where you're going to leverage a line of credit. Let's say, again, you got a $50,000 line of credit, you got this $300,000 mortgage, and you're going to write a $40,000 check, then you're going to send it to the mortgage, okay, paying down the balance here, and then you're going to bring that over to the line. Then you're going to use your positive cash flow every single month to pay down that line. Once it's paid down, you're going to make another chunk. You can use the cash value in your policy in a very similar way. And again, this definitely removes some of the perceived risk around leveraging a line of credit, because again, the policy loan, it isn't necessarily a line of credit. Again, your insurance company isn't necessarily a bank. So in that scenario, let's say you had your $300,000 property and you have, let's say, $50,000 in cash value in your policy. You could go ahead and get a policy loan. Let's grab 40 grand of that cash value and put it directly on the principal of your mortgage, knocking it down by 40 grand. Again, continue making your minimum payments on there every single month, and then take your positive cash flow every single month and replenish the cash value in your policy. If something was to ever come up where it's like, okay, I need to hold on to this cash, hold on to my cash flow this month for whatever reason, again, there would be no drawback because there is no required monthly payment on that insurance loan. And so it's a very flexible and very convenient option to, again, bank on yourself, fund larger purchases, or certainly to be used in conjunction with velocity banking. Now, if you do have a very high cash value policy, maybe you've had this policy for a long time, it's got a ton of cash value in there. Could you just simply take out a policy loan to pay off your mortgage in full? Yes, you absolutely could. And then you could just go ahead and start applying all of your extra cash flow every month directly to the policy loan to, again, replenish that account so that way you can use it again in the future. So really, guys, that's the difference. Again, Velocity Banking is primarily leveraging a line of credit to pay down amortized loans, save a bunch of money in interest. The concept around infinite banking is around that concept of banking on yourself. Again, this is a way to gain access to capital without going necessarily through the banking system. And yes, you can use infinite banking in conjunction with Velocity Banking. You could use the cash value in your policy essentially as your Velocity Banking tool, or sometimes it's called a debt weapon. Instead of a line of credit, you could be leveraging the cash value in your policy to chunk down your mortgage. Or again, if you had enough cash value, you could pay off your mortgage in full and then eliminate that mortgage payment just directly out of your equation, add that to your cash flow, and from there start replenishing and paying back your policy loan. So be on the lookout. I'm going to be putting out a ton of content to really just help bring people up to speed on this concept of infinite banking, or again, it's called cash flow banking sometimes, but we're leveraging permanent life insurance policies. Again, I think this is incredibly important. Permanent life insurance is an incredibly powerful tool. It's a fantastic wealth preservation tool. And again, that cash value that grows on that policy is tax-free. So there's a lot of different advantages to it. So there's going to be some more training coming out about this. But hopefully you guys found value in this training and in this breakdown, kind of just describing the difference between the two. Be curious to hear what you guys think about this. If you guys are out there and you have permanent life insurance policies, do you like the idea of leveraging the cash value in your life insurance policy to do Velocity Banking? Is it something maybe you've already done? Because I know that I've certainly recommended it to several of my clients. So I'll be curious to hear what you guys think about this. But hopefully you guys found value in this training and in this discussion. If you did, make sure to give this video a like and give it a comment below, and I will see you in the next video.